Testing. There we go. Okay, so this session I'm going to be doing a fireside chat with Matt Allen. Matt is the co-founder of Tractor Ventures and also of Side Stage Ventures, and I'll let him give a bit of an introductory on that. Super excited to be doing this. And first thing I just want to say a big thank you to Matt. He's obviously flown up from Melbourne for this, and also in sort of observing you for the last sort of 10 years, there's funny things you come across, we've obviously been doing this for 14, 15 years, and you come across a bunch of different people sort of in this area. But the very rare type of person you come across is the people that actually do all the work at the ground layer to actually help build the next generation of entrepreneurs coming through, and also proactively building ecosystems around what they do as well. And I know that for you, you've been involved in so many different layers, whether it be startup ecosystems, different organizations. Like I'm sure you've been to countless events like this, actually doing everything just to try and help people build. And the record of companies that he's been associated with as an investor or as an advisor is just absolutely astonishing. So welcome, Matt, to the Fireside Chat.
Thanks for having me.
You brought your own fan club as well. It's fantastic.
Is it on? Does it work? Yeah, right, cool. Now we have, hello everyone.
So Matt, as a starting point, please just obviously I've given you a bit of an introduction, but, I'd love you to give an introduction for yourself about your own sort of journey in this space, firstly as an angel investor, and then obviously, starting Tractor Ventures. And I suppose the motivation as to why you started Tractor Ventures.
Sure. It all starts back in the mid-90s because I'm old. So the first half of my career as a software developer. So I'm kind of a weird mix of spent the first half writing a bunch of code and building a bunch of software for the internet mostly. Was always sort of on this mission to become a business person. So when I sort of hung up the coding keyboard and decided that I didn't want to write code anymore, I actually built a recruiting company and sort of build out the software engineering teams for the big scale-ups in Melbourne, like realestate.com.au and Redbubble and Jetstar and so forth, which is kind of convenient because it also was the beginning of my angel investing career, and recruiting is very lucrative, especially when you're hiring software developers and your mates are all the CTOs of this company. It was kind of a perfect storm back in the mid-2010s. Interestingly enough, my investing career started because the last thing that I coded was a company called Practice Ignition, which is a scale-up Series C company, worth several $100 million now. And it was sitting on top of Xero. It was all sitting on top of Xero, the accounting platform back in 2012. And I made a very dumb, good in hindsight, dumb at the time bet, and basically set up an SMSF and dumped my wife and I's entire SMS on Xero on the ASX on day one, and just went like slid over. I don't know how many tens of thousands of dollars that was, and it went pretty well, which gave me the capital to then start investing in early stage tech companies. And conveniently, a lot of the first investments I made were from Practice Ignition, the one I built, and my mates who were software developers who were doing startups who just went, "We don't know how to raise money. Can you help?" So that was convenient. After recruiting, I went to AWS. So there was a time, a couple, 2.5 years, sort of finish up in 2019, where I ran the venture capital and startup team at AWS. So that was interesting. I was in a BD role, didn't have anything to sell, but I did have $100,000 in AWS credits to give to whichever founders that I decided to talk to. So there's a little bit of like drug dealer, first one is free stuff with the cloud. It worked well for Amazon.
Good way to make friends.
Worked well for me. And also because I was looking after the VC portfolios, I was able to speak to all the VCs. But it was really at that time when the thought process behind Tractor started. In technology, the VCs like to speak to all the founders, but they invest in so few companies because venture capital requires a ridiculously large return. And, those venture funds are happy to have 8 out of 10 of their portfolio go to zero, while hopefully 2 out of 10 sort of return the majority of that fund. And it was my time at Amazon when I used to get these spreadsheets full of this sort of billing data that sort of showed these companies growing and going up and to the right. And you'd click on them and you'd like, who the hell are these people? I've never heard of them before. It's not Canva, it's not Atlassian, it's some random thing. A couple of dudes in a shed in Ringwood, doing $4 million a year in revenue. And they're not venture backed. They didn't want to be venture backed. but they're always happy to have entertain the idea of taking more capital on to grow their business, and there's just really no way to do that. So there's kind of the thought process behind Tractor, which is a bit of a funny / silly name, is I wrote a thesis that said, in VC land, everyone talks about unicorns. You all sort of heard about these unicorns. It makes us sound like a bunch of fucking children. So how about we write a thing called, and I'm like, maybe it's tractors versus rockets. So the rockets are, they're exciting, they're expensive, they're hard to land, and they blow up pretty often. That sounds like the venture capital financial vehicle. And tractors are consistent, reliable, and they just keep going. So we started Tractor Ventures to sort of fund this asset class that was kind of invisible, where they're not risky enough for VC and they're too risky for banks, but they're still sort of scaling product companies being led by founders who are growing, who want to grow, who just sort of aren't risky enough for venture. And the banks, they're non-tangible asset companies. There's nothing to touch. The balance sheet's got some IP and some laptops, and that's about it. So that's what we do. So Tractor is a cash flow, a revenue-based finance company for people that have scaling tech companies that have identified that they can put more capital in and grow their business.
So there's really two sides to it, right? One, you've got to sell you've got to communicate and articulate the proposition to the founders, and on the other side, you've got to articulate the proposition to the investors. How'd you go articulate to founders in the early days, like when you were starting, just for the fact that this whole ecosystem I found sort of frustrating is geared towards how to pitch a VC and how to create a pitch deck. How did you find that when you're actually looking for tangible, when you've got a different approach in how you do it? Yeah,
it's interesting. A lot of tech founders sort of get swept up in we've raised money from insert large venture fund here. Their AFR never writes an article about some people taking finance. It just doesn't happen. So, if you want to get written up by the AFR, you've got to get Blackbird or Airtree or Square Peg to drop a couple of bucks into you and off you go. So it was really interesting, and especially we started in December 2020. So I wrote 2 loans myself leading up to then, and we officially launched in December 2020. And if you all remember 2021, money was free, and the VC funds, especially the big ones from the US, were doling it out like lollies, which meant that when you said to a founder, hey, maybe you shouldn't sell those shares and retain them for yourself and use some of my money because you've got millions of dollars in revenue. We can use that to help you grow faster and you don't have to sell as many shares. They were like, nope, I'm just going to take this equity over here because the valuations are toppy, things are happening fast, and off we go. And founders, interestingly enough, usually really great at product, and they sort of wrap a great solution around it, and they sort of business around that, and finally they think about how to finance it. And it's up until recently they've had to sell shares. It's either customer revenue, friends and family, or other people's money. So in 2021, we just sort of went about saying maybe you shouldn't do that. The hardest thing to get a founder to know the hardest thing to get a founder to do is say no when someone wants to buy shares off them. Like they're just happy to sort of do that. So there is definitely some education at a high val. So fast forward to 2022, and all of a sudden, we say that in 2021 the founders were curious, and in 2022 they became serious about using alternate finance to grow their businesses because the equity markets dried up. So equity and interest rates are inversely correlated. Interest rate goes up, prices go down, founders stop selling shares, people stop buying shares, and all of a sudden they're like, maybe I could use other forms of capital to grow my business. So the tailwinds really whipped sort of at the end of 2021, beginning of 2022 for us, and it's been quite a significant growth for us since then.
You made the offhand comment about getting the big round, obviously being featured in the media and so forth. And I think as a founder, sometimes when you're building, you get envious when you see those big rounds. You see a company's just raised 60 million, 30 million, 100 million, so forth. And that's in 2021. And then you see in 2022, and I'll never forget this moment. I remember speaking with one of our clients, and they'd been VC funded. They'd just gone through a sales process, and I was ringing her up to congratulate her because it was actually covered in the media. And basically at that point she goes, and then she was mentioning she was going on a holiday, and I asked her, are you taking a 3 to 6 month break to celebrate? She goes, well, we actually didn't make any money out of it, because effectively the preference shares. And that moment, it's funny, you hear that word, but when you actually hear someone who's a founder who's put their absolute soul on the line in building a business and actually sold it, which is our dream for every founder, and walked away with nothing, you're like, okay, that wasn't what I was expecting. And you think, so I said, you hear those stories in sort of 2021, and then you hear 2022, And then you hear about some of the situations founders find themselves in from taking those top evaluations with preference shares, with lots of money attached and massive burn rates attached and told to grow, 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 grow. It really does put a different perspective on, what should growth capital look like going forward.
Yeah, I mean, we talk to founders all the time about, like, as soon as you take other people's money, just be really clear about, the devil you're making a deal with, right? I also have requirements for my capital, but they're quite clear. It's like, pay me back over 2 years with a bit of interest, and that's very different to saying, I want 10 to 100 times my money back. And the problem you've got with that particular type of capital is, if you were on a rocket ship and then all of a sudden the market changed and this happened, I saw this happen so many times, that the VCs went, well, you're not in the top 5% of my portfolio. They sort by kind of awesome descending, whichever their definition of awesome is, and chop off the bottom 80, 85%. I got founders calling me going, like, last board meeting, they said hire more people. This board meeting, they're like, make your runway go for 5 years. And it's like, how do I do that quickly? It's not, the challenge that I've got is that my friends are all VCs and they're lovely people. It's just that their business model is a shit show. It forces it to do that. And, let's be clear, I have a business model as well, but it's very clear about what we need. And it's far less pressure most of the time to do those kind of things with your business. So
now, as I said, that people are getting serious about it. Like, one of the things me and you in our sort of pre-chat before this, we talked about, obviously the fascination I love about software because of the infinite scalability. Obviously, then you could bring in generative AI. I suppose the question, when you're thinking about the companies of the future, and obviously you focus on your business models, you focus on side stage ventures as well, which we can talk about. But how do you see the business models of the future? Is there the need for those massive, like, outside the tech, like, we've obviously got a lot of renewable energy tech business. Technical businesses require lots of capital, right? But for the software businesses, do they require those large funding rounds going forward?
I mean, it is the topic of concern. I mean, when I did my first startup in 1999, the 3 machines cost me 25 grand a pop each to buy and 5 grand a month to run each. The capital requirements were quite significant even to get to the game. Now you speak to your friendly AWS guy, get 100 grand worth of credits and you're off to the races. And I do think that the ability to get software to a point where you can solve a customer problem is much shorter. And in the days of free capital, you could overspend and hire a big team. But yeah, it's interesting, especially in Australia, and I'm certainly tracked, it perpetuates this problem rather than solves the problem, which is you should be able to get to customer value and potentially revenue relatively quickly with relatively low costs, even if you're not a coder, because of some of the tooling that's around there. And you're not going to solve the entire problem, and it's not the eventual thing that's going to make you, hyper rich. But you should be able to validate that it's real without spending a whole bunch of money. And Australian VCs traditionally are very bad at investing in ideas. They don't sort of go that early very often. Some do, like we do every now and then, but it's there's other factors involved then. So, yes, I reckon that the software stack of the future will be very different. The generative stuff is kind of mind-blowing. It can do all kinds of stuff that required deep skill sets like coding prior to last year. It's only brand new, so it's a bit unknown. And yeah, there was a couple of articles, I think, was it Forbes or someone did, the startup of 3 people. It's like the just be able to prompt the AI to write the code, to be able to build the stuff. It's not a long way away. Like, I don't think it's impossible.
And then you start to think about, well, some of these companies that you're funding right now, and this is, I suppose, the thought process going through my head. You think about, obviously, the technology aspect. Then you think about, obviously, there's the social media platforms. If you're a B2C business and you want to get reach at scale. If you're a B2B business, you can literally just buy the data and do the scaled outreach of whoever you want to target. So, should we be, from an investor's perspective, thinking that the software companies coming down the pipeline should be we should be looking at some of the most profitable companies over the next sort of 5 to 10 years because of, I suppose, those head starts?
I mean, I've got a strong view that, as you said, the margin on software ends up being, infinite because you can resell it over and over again. But I think, again, some of the biggest thing, the biggest problem with the overcapitalization of businesses is that they forget that you should run an actual business. That the high margin, high growth software businesses with doesn't need a whole bunch of people, shouldn't need a whole bunch of people. There's plenty of businesses out there that are doing the physical stuff that, that do need a bunch of people and do need a bunch of warehouses and need a bunch of things to be able to actually get them going. But the ones with sort of infinite margin software should be able to do that without a cast of thousands.
Now, obviously, you've got two businesses that you're co-founder of based on your investment thesis, what you're passionate about. What is Matt Allen personally excited about for the next sort of 3 to 5 years?
Personally excited, I don't know.
Or angry about, one of the two?
I don't get super angry. I'm pretty chilled. Yeah, that's no. Going to talk about what I'm worried about.
Go for it.
I don't know. It feels like there's some significant changes in the world that are pretty existential threaty to us. Not that I worry too deeply about them, but the way that some of the odd shit that's happening in the climate, that's sort of first times. It feels like the mean time between first time things happening is getting shorter and shorter and shorter, and the compounding effects, and we just don't know what's going to happen, which kind of just makes me want to go really, really fast to whatever success looks like and enjoy the rest of it before it'll burst into flames. Sorry.
Should we be prepping and buying a farm in Tasmania?
I'm not going to lie. When COVID came along, I did do a very large Amazon order of tuna and water. But I'm like, to be clear, I ate the tuna.
He secretly owns land in regional Victoria in a bunker.
I did live on a farm once. No, it's just I do think that there's I would like to see some urgency in some of the stuff around climate. I think that some of our favorite billionaires, tech billionaires, are throwing basically all the money they've got at it. And, the people who think about innovation and think about the future and think about the ways that software, hardware and products can solve for some of these things are basically investing every dollar they've got. And I think it's a strong leading indicator that we should all be thinking about it all the time.
This could be a bit leading, right? But you mentioned that. It's funny enough, you're a software guy talking about, obviously, you would have walked around today and see how many renewable energy tech companies or hydrogen based. What's fascinating for me is you don't really see it covered that much in startup media, in business media, in AFR, and so forth. A lot of the great work that's being done by some of these companies. Yeah,
and a lot of the time it's because their capital requirements come from places that are not your headline venture funds. They're coming from different places. People like
it's family offices and high net worth.
A lot of them get to the point where they can find asset finance or supply chain finance their growth, and it's just not the thing that Swanee talks about, right? It's boring as shit, but it works if you get it right. Yeah.
And is there any questions anyone wants to ask Matt, just while we've got no time left? Maybe two questions from the audience. Anyone want to go?
No. Oh, there's one. Have I invested in climate tech myself? Yes, I invest in GoTerra, which is that takes all the food waste from Woolies and a bunch of places here in which I think is really important. I think some of the funds I'm in have done it, but not directly. I haven't done many direct investments because I'm focused on Tractor at the moment. Tractor has actually got a whole bunch of things that are climate related in them when they're able to sort of get to the point where they're able to have revenue and scale. So, yep, definitely doing it. And my team is super focused on that. I've got a few conversations in place with some climate tech lenders who can only lend to big projects and trying to get Tractor to allow them to do some of the smaller projects so they can actually get some more capital out. These huge funds, the CEFCs who have $200 billion on their balance sheet, it's very hard for them to write a $5 million check because they don't have the team to do it. So, try to figure out how we as our platform can get some of that money out into earlier stages into companies like that.
And one more question for Matt before we finish up. Oh, we've got two. We'll go two. Given I know Matthew well, go for it.
If you were starting off as an investor today, knowing what you know now, how would you go about sort of building deal flow and establishing the connections to get the right opportunities?
Yeah, I get this question pretty often. Stay in your lane and stick to your knitting. So there's something way more about than everyone else in this room. Go out and find founders that you can have an intelligent conversation with, and try and create a bit of leverage for yourself. So, my first portfolios were all dev tools that were selling to software companies, and I was a software developer, so I was able to understand the problem quicker than anyone else in the room, which allow you to build trust with the founder, gives you access to deals because you kind of understand the problem already. You know, like there's an inverse correlation between how less you know about something and how exciting it is. So if you actually know something and you can still be excited, then write them a check.
That's gold. Matthew.
All right, yeah, Tractor. So we do loans from 100 grand to a couple of million. It's usually 2 to 3 times your monthly revenue is over in a payback period of 24 months on average.
Sure, why not? One more. Sorry, Lou, wherever you are.
Good question. Yes, how do we
More
get out?
side stage, isn't it?
No. Tractor is funded. So we're funded by family offices at the management level, and we have a very large wholesale lending platform. So you can lend into our lending platform, which I can talk to you about, and that's yields quite a lot, paid monthly, 18-month term. And then at Tractor, we have shareholders who have supported us on the balance sheet. As we grow the lending company, we need to grow the balance sheet as well. So the answer is yes. Come and have a chat if you're interested in what we do.
All right, official last question. Ram.
Matt, well, going by your sticking to your lane approach, let me ask you a question about what is your observation on Australian startups looking at India? Have you seen any of your portfolio companies actively engaging in a dialogue about potentially wanting to go there? If they're going, what sectors you're seeing? If they're not going, why are they not going?
So startups going to India, that's the question? No, not certainly not as a motion, and certainly not more than 1 or 2. It's to be really frank, it's usually if the founders have a connection over there. It's probably unlikely to be as high on the list of places to go first, mostly because it's probably a long way away. And founders they like raising capital. They like to go to the States because it's big and relatively well known. So I imagine there's a whole bunch of things that are just unknown about it, and there's certainly not a lot of information flowing back in to suggest why that would be, except that there's obviously a lot of people there. So if you want to go to a big market, I'm sure they should go. But I can't tell you why it's not number 1 on the list.
Okay, thank you.
Right, Matthew, thank you very much for your time. Appreciate you coming. If you'd like to learn more about sort of Matthew's fund or investing in projects, please have a chat with him. All right. Shella, I'll let you do the introduction for Lou.